Good evening, everybody. Welcome to the Collegio Carlo Alberto. I'm really pleased to open this forum, which is the CEPR European Conference on Household Finance for 2023. I'm very pleased that the Collegio Carlo Alberto has been the seat for several European CEPR European conferences this year. We had ERWIT, we are having another one on industrial organization later on, and we keep organizing conferences jointly with CEPR, which is very important because the Collegio is an institution that is at the heart and at the core of European intellectual thinking and European economic analysis. So CEPR is the obvious partner, and we're very, very pleased to work with them. Of course, this conference has been organized by many different institutions, from the National Bank of Denmark, from EDEC Business School, and Queen Mary, and other institutions. The list is very long, so I certainly forgot some of them, and I'm sorry about this. And I'm really pleased that we have a very extraordinary international audience. And I have to thank Giovanna Nicodano for really being behind this conference. I think we wanted to organize it, if I don't remember wrongly, we already wanted to organize it when COVID started. And so we couldn't do it because there was COVID. So finally we managed. A lot of things are happening after COVID. And really thinking about pensions. You want to say something? No.
Also
Laurent Calvet? Laurent Calvet, yes, I was about to read your notes. Joanna gave me very detailed notes of all the people I should be thanking. So, yes, Francisco Gomez and Laurent Calvet, exactly. It was written on the paper, so I haven't said it yet, but I was going to say it. And I also it's very important that we're talking about pension, because really this house is the house of the Italian pension reforms, and as you all know, and Elsa, and before her, and with her, her master Onorato Castellino were really two big drivers, two big triggers, and they made most of the analytical thinking for a lot of the pension reforms in Italy, and their work was extremely influential. So it's very interesting that we discuss pension here and in this international framework, and I'm really pleased we do that. This is a good accomplishment for Il Collegio, and thank you, Elsa, for all the work you have been doing and you're doing for Il Collegio. Actually, we are having a policy panel today, and with Elsa and Mario Padula and Steven Zeldes, that will be the panelists, and Monica Paiella will be the moderator of this panel. And of course, then tomorrow, and tomorrow there will be a lot of, tomorrow and Friday, a very, very intense program with very interesting papers. I'm really pleased that we are having all this activity here. I want to thank all the staff of Il Collegio, of course, for, I see Silvia somewhere there, for organizing all this and for working on that, on this program, and also CEPR, that of course was very active in organizing the conference. And besides for Il Collegio, the other sponsors are also, and CEPR, of course, also ESOMAS, who is the Department of Economics, one of the two Departments of Economics of the University of Turin. So welcome to you all, and I'm not going to say any more silly things here as an introduction, so I leave you the floor, and I am sure it will be a very interesting and fascinating panel and conference. Thank you very much for being here.
Thank you.
Okay. Acceso? Should be. Okay. So thank you very much. It's really a pleasure to chair this panel on pensions and thinking forward. And I will start by introducing the panelists and then motivate the discussion which is the topic of the panel. So the first panelist is Professor Elsa Fornero. Elsa Fornero is Honorary Professor of Economics at the University of Torino, so a university here. And she's the scientific coordinator of the Center for Research on Pension and Welfare Policy, which she started in 1999. And this was the first center devoted to research on pensions in Italy. From November 2011 through April 2013, Elsa served as Minister of Labor, Social Policies, and Equal Opportunities. And in this role, she conceived and implemented a major pension reform that was an important step towards intergenerational equity in pensions and towards balancing the budget. Now, the second panelist is Professor Mario Padula, who's Professor of Economics at the University of Venice, Ca' Foscari. And Mario's research is mainly in the area of pension and financial literacy. Until last March, Mario acted as chairman of the national authority responsible for the supervision of the supplementary pension system. And among other things, he actively contributed to the consolidation of the market for pension funds and to increase second and third pillar participation by those segments of workers who participate the least and would benefit the most from participation, which are young workers. Now, the third panelist is Professor Zeldes, who is a Benjamin Rosen Professor of Economics and Finance at Columbia University. His research actively examined a wide range of issues related to Social Security reforms, the design of defined benefit contribution systems, and the measurement of defined benefit pension liabilities. Steve co-authored 2 studies awarded the TIAA Kraft Paul Samuelson Awards, a paper on precautionary saving and social insurance, winner of the 1996 Certificate of Excellence Award, and then a study with title Social Security Money's Worth, which was the winner of the Paul Samuelson Award. So it's really a pleasure to have you here. Now, before handing the floor to Elsa and then Mario and Steve, I would like to present a few slides to motivate the need to think forward when it comes to pension. Now, what is probably the main reason is the well-known phenomenon of aging populations. But there is also a second reason, which is more strictly related to the current economic situation, but can be expected to have a long-term impact on pensions, which has to do with the recent surge of inflation. And the fact that in defined contribution or notional defined contribution systems, contributions are related to earnings, and earnings are only partially indexed to inflation or indexed with some delay. And as a consequence, contributions paid in now may result inadequate for pensions 20 or 30 years ahead. But let me start with the aging of population. Okay. So this is an issue for most industrialized countries, and it is the result of 2 trends. One is increased longevity, people living longer, and the other is the decline in fertility. So fewer children being born. And the latest figures for Italy set the fertility rate of Italian women at 1.3. So these charts show the old age dependency ratio, which is the ratio of people above 64 to the number of people of working age, aged 14 to 64. And what we can see is that the old age dependency ratio has increased dramatically everywhere between, so we have the first chart is 1950, then we have 1970, 2000, and 2021. And actually on the UN website, there was a nice video with a progression, but I wasn't able to include it in the slides, so I took a few snapshots. But this gives you an idea of how the phenomenon has progressed over time. And here there are a few numbers. We can see that between 1950 and 2020, the old age dependency ratio has gone from 13 to 26 in the US, has gone from 16 to 30 in the UK, 14 to 30 in Germany, and from 8 to 51% in Japan. So, from the perspective of social protection, an aging population raises several issues that range from health, labor market, but if we stick to pensions, the main problems are related to the fact that most people rely on retirement benefits, which are paid by the state, and most public pension systems are pay as you go. And with aging population, what we have is that the number of benefit recipients increases, whereas the number of people contributing to the system shrinks. So what governments do to pay pensions, they rely on general tax revenues, and this creates or raises budgetary problems. To address this, most governments have adopted a set of reforms, and essentially there are two main types of reforms that governments can adopt and that have been adopted by most governments in industrialized countries in the recent past, which go from the parametric adjustments of structural characteristics of the pension system, which means raising retirement age, raising the rates of contribution, revising the benefit calculation formulas. An alternative has been to take more systemic reform, moving the system towards a defined contribution, fully funded pillar inside or more often outside existing public pension schemes. However, related to these two reforms, we can make a couple of points. The first is that the effect of these reforms is not immediate. What we can see here is that despite the fact that most governments, especially in the EU area, have adopted quite dramatic reforms to address the fiscal, the budgetary problem linked to the payment of pensions, still what we see is that public pension expenditure as a share of GDP is increasing in many countries. And if we take the EU, we see that on average, pension expenditure is going to peak around 2045. And only in 2070 is going to be back to the current levels, which are considered high and unsustainable for many countries. But the second issue related to this reform is that what the reforms have done has been either to reduce the pension coverage ratio or to reduce the benefit ratio. Reducing the pension coverage ratio means reducing the number of people receiving a pension, and this is typically done either raising retirement age or moving the system towards a second pillar outside the public system. But more importantly, what has happened is that there has been a decrease in the benefit ratio. The benefit ratio is the ratio of pension expenditure to wages. And we see here what is expected to happen from now and 2007. What we see is that over the next 50 years, the average EU pension benefit ratio will decline by 10 percentage points, with peaks of over 20 percentage points in Spain, Portugal, Greece, and Poland, which is not in this chart. Now, the public pension benefit ratio is a measure of the generosity of a pension system, and when it declines too much, issues of pension adequacy arise. Pension adequacy refers to the capacity of a pension system to keep living standard for retirees adequate and high enough. Now, to offset this, or to reduce this, or to address this pension adequacy issue, there are the second and third pillar, which are whose investment is strongly encouraged by governments, but whose diffusion, especially in Europe, remains quite low. And what we have here is a chart that shows the distribution of pension assets, which at the end of 2021 amounted to over $60 trillion worldwide. But we can see from the chart that in Europe, if we exclude the UK, Sweden, Switzerland, and Belgium, and the Netherlands, essentially there is very limited participation. And among the possible explanations for this, there are the contribution rates to public pensions, which have been rising, which many governments have been rising over time. And here we have a summary of the contribution rates of some European countries, and we can see that they range from 17% of Sweden to 35% of Portugal. So this could explain why in countries such as Italy, where the contribution rate is around 33%, investment and participation in the second and third pillar are very low. And investment or participation in the second and third pillar is the topic that Mario and Steve will address in their contribution. But now I'm leaving here a couple of points for discussion later, and hand over to Elsa, who will tell us about first pillar reform.
Okay.
Elsa.
Okay. Thank you very much. I'm happy to be here. I like participating in discussion with, particularly with the young, because I've discovered that their knowledge and their confidence on pensions in almost all countries that I've visited, been invited to, is very low. Generally, there is no confidence. The young say, well, I will not have any pension, so why do you ask me my opinion on public pension? This is the typical answer. But this is also due to a lot of misunderstanding. And the misunderstanding in terms of pensions and pension reforms are quite widespread. First, I would like to say one thing. Believe me, there is a huge, huge difference between studying pension reforms in your office in a university, discussing with colleagues, developing ideas, and having to enact a reform which changes individual plans, not marginally. And when you have to do this in 15, 20 days, it's really difficult. It's something that in a model cannot be embedded, cannot be formalized. So in case they ask you to become a pension minister, think twice. This is my first advice. Where do I move this? Thank you. So there is in my presentation some overlapping with what Monica has just said. But I want to start with basic because I said there is a lot of misunderstanding. So first I would like to say, what is a pension? A pension is not a financial product. A pension has inherently an insurance component because it's something that can give you a kind of security for a period in which normally you don't earn an income, and it says, okay, I will pay this, maybe an amount which is fixed nominally, and so it does not guarantee against inflation, but until you are alive. I provide you this flow until you are alive. And if you want, I can give more. I can give a survivor benefit in case you have a dependent wife or dependent children when you die. And so it's quite important to have this insurance in mind. I say this again because many people think I've paid, I want my money back. Your money back can be given, but it does not guarantee you until you are alive, first. Second, a public pension. Okay, we can buy annuities in the marketplace, but you all know, being economists, being young economists who do research, you know that the market for annuities is thin everywhere and has a lot of shortages, a lot of defects. And so, well, sometimes governments try to promote participation in funded pillars, in private components, but it's not the same thing. So I do not go into the origin of these public schemes, but the origin were the mutuality. People wanted to share risk, and they understood that if they were, let's say, workers in a given sector in a coal mine, they needed to stick together to share risk that somebody would be disabled following an accident or would left a widow and so on and so on. So this sharing of risk is fundamental. The state at one point, the third element is risk is everywhere in the funded and unfunded pillars of the pension scheme, in the micro perspective as well as in the macro perspective, because we have shocks that were not predicted, and they are big shocks and they are macro shocks. The only possibility is to try to have integrated schemes so that risk is differentiated as much as possible. But the origin of a public pension scheme was a financial crisis. We have to remember this because in the middle of the two World Wars, many schemes were funded, but at one point it was seen that the reserves were not enough to pay. They were simply not enough. So the state, the government said, but do we really need reserves to pay for pensions? No, the state has infinite horizon, not like an insurance company. And so we may say, okay, you are the workers, you pay contribution, I establish compulsory participation so that no one can escape the scheme, but I use immediately the money that I get from your contribution to pay for their pension. This is the origin of the pay-go. You pay, they receive. Why do you pay? Because you have, well, first of all, because you are obliged. But second, nobody asks you whether you want or not. But in any case, what happens is that you also pay because you have confidence that in the future, there will be, when you will be here, there will be other young people paying contribution, which will be used to pay for your pension. So it's a kind of schemes that nourishes itself in a way. So this is the pay-as-you-go. Monica has already said that there are three basic elements that can support a pay-as-you-go scheme. One is demography. And we have demographic problems, particularly Southern European countries, Italy, in particular Greece also. We have demographic problems. Of course, world population is still increasing, but I also have a graph, and you see that on the left-hand side, you see that world population will go into negative rate of change around almost now. And so a total population will start likely, very likely, to decrease. But look at the blue line. We have been for, a decade now, 10 years now, we have been in the negative. So our population is projected to decrease, someone say by 20 million. Out of 60 million people, Italy will decrease by 20 million by 2100. I don't know, we'll see. You will see, not me. In any case, the difference between the birth rate and mortality is the reason. Okay, but going back again, the first element is demography. If you rely on this intergenerational contract, I said before, you need to know that when you will be there among the old, there will be enough young people who work and who pay contributions to pay for your pensions, because no reserves are set aside, except in Norway, where they found a very nice fund from petrol, from oil, and so they established a fund which was established exactly for future generation. They were thinking ahead before we did. In any case, second, growth, economic growth. That is often forgotten. But I said before, intergenerational contract. So you pay contribution on your earnings, an established tax rate, a payroll tax rate, 33% in Italy. Okay, and then you will be there. And imagine that the next generation following you as labor force is increasing by N, the rate of growth of the labor force, okay? And then it's also increasing its productivity. So next generation will be more productive. And so the earnings will be higher. So they will pay higher pension to you because the system does not need to have surpluses. And so it's like you are now investing in human capital. You are investing, you will get a return, which is the internal equilibrium rate of return of a pay-as-you-go system, a return which is approximately N, the rate of population growth, the labor force growth, plus G, productivity growth. So when people say, well, but if I put my money in financial activities, assets, I get a return. I get a return which is R. And if I put my money at the IMPS, which is our pension institute, what do I get? It is very, very difficult to explain that potentially they get a return. And the return is given by the rate of growth of the economy, approximated by the rate of growth of the labor force and the productivity. Okay, the sum of the two. So I say in one case, if you follow pension funds, then you invest in financial activity. But if you are in the pension, pay-as-you-go pension system, in this intergenerational contract, your return is given by investment in human capital. It's number of workers plus the rate of increase in productivity. And the third element is public, no market here. So it's public, where do we, democracies, establish rules, laws? In parliament. So the third element is democracy and politics. Okay, and so politics establish the retirement age, establish the tax rate, establishes the pension formula. The generosity of the pension formula is given by the difference between the present value of your future benefit and the present value of the contribution that you have paid. We said that in equilibrium you can get N plus G, and this is sustainable. But if politics say, no, I want to give them more, then your rate of return is increased somewhat artificially, and it is not sustainable if it is permanent. If you don't have, let's say, a source of income supporting the promises, then the system becomes unsustainable. Okay, if it is here demographic winter in Europe, we have most of countries in Europe will lose. Put the migration into the perspective of Europe as a whole, losing something like 40 million people in the next 40 years, while at the opposite side of the Mediterranean Sea, the African countries facing the Mediterranean Sea will increase their population by 200 million. No way to stop them, no way. Okay, that can be my let's say, very short assertion for migration is that no migration can fix a pension system which per se is unsustainable. But migration can be useful to oppose the effect of population aging on pension. Here is the old age dependency. Already Monica has thought about this. This I've already told you, investing in human capital and getting N plus G. So it means that economics matter. And look here, what I call the Italian disease, which is lack of growth. If I take, here we stopped before the COVID. COVID changed everything, and even now the good growth that we have is not sufficient to compensate for the 20 years of very, very moderate growth that in comparison with other countries we have had. So our problem, when we say it is structural, And our main problem is called lack of growth. And this is why, parenthesis, the PNRR, that is the Plan for Resilience and Recovery and Resilience, for us is very important because it is structural and because it can be an investment to raise potential growth. Okay, directions for reform. So reforms are needed because sustainability is not defined precisely. But when you have, as a country, you have all international organizations, the EU Commission, the World Bank, the IMF, all of them, the evaluators, they say you have to enact reforms, you have to enact reforms. Every time a report is issued, the recommendation is this. And what do? You do a reform. And what are the directions for reform? Increase effective retirement age. This is more controversial. Link retirement age to longevity, which we did. Now it has been stopped until 2026. This indexation of retirement age to longevity has been stopped. By the way, we had a reduction of longevity during the COVID period. So that would have been, let's say, a positive element in the calculation. But it is stopped. Anyway, this is quite controversial. We may discuss this if you want. Boost employment opportunities, encourage participation in supplementary private pension, then reduce privileges and make redistribution clear. We are talking of a public pension system, so solidarity needs to be a feature of a public pension system, even when you move in the direction of DC formula, which means you pay 100 and in actuarial term you receive 100. That is actuarial neutrality of the DC. It's not perfect, of course. But then you need to have a solidarity. What kind of forms can solidarity take? For example, you are unemployed, you are looking for a job, but you are unemployed. And the state, out of general taxation, which is progressive and not proportional as payroll taxes are, can pay contributions for you during the period in which you are unemployed or the period in which you are out of work because you have care activities to do. For example, parental leaves or absence for work because you have a person in the house that needs to be looked after permanently. Okay, and then attention to transitional issues. This, I can just say that if you are in an emergency and you have to do in a fortnight, attention to transitional issues is difficult to be obtained. Okay, Europe is converging towards a good design. There is some convergence. I do not want to take much time, but what I say is that there has been a general movement toward more DC pensions. Retirement ages have been raised. Access conditions to early retirement have been tightened. Benefit indexation, this is everywhere. Once the indexation of pension benefits was to wages, meaning that there were two components, prices and real wage growth. The second one is being cut almost everywhere in Europe, decades ago. Now we have only prices and very, very imperfectly. Then transparency, pre-funding, it means participating in. Now, I have 3 minutes more or no?
Yes.
Tell me, 3 minutes. Why is pension reform so difficult? Think of Macron. In the end, he succeeded, but it was very difficult. He said that the pension reform should have been the first thing in his first mandate, not the second one. He did in the second one, and he had the country against. And he wanted, and he did increase the retirement age by 2 years. So by some other countries' standard, this is not a very harsh reform. In any case, it's difficult because, mainly because, you know, in politics, there is a tendency toward looking not to the future, but looking in the very short term. Because typically they look at the next election, and the next election are months away, not years, not decades away. So you talk to the electorate, and one of the most popular things for the electorate is to say that either you reduce retirement age, or you increase pension, or you improve indexation. And this makes the political party supporting this measure quite popular. If you have to say, no, we have to increase retirement age, or to, this is very unpopular. Also because, as I said, well, the reform is mainly in the interest of the young, but the young electorally are, weigh less and participate less to the election. This is everywhere in Europe true. I don't know in the US. And then it's an issue permeated by ideological value judgments. So people, for example, think in terms of acquired right. It is my own right. I was promised this. And if you say, okay, it was promised, but it was promised to you without specifying that those who will need, or are just now paying for your pensions are poorer than you are. Poorer. Is this social justice? No. In my view, not. But it is difficult to convince people. And so, well, the final thing is, this is about the famous Jean-Claude Juncker aphorism. You know this because it is quite famous now. He said, well, we all know what has to be done. What we don't know is how to get reelected once we have done it, which is very, very cynical, I say. And the answer is quite simple. Well, if you know and they don't, why don't you explain? That's why I am really convinced that social dialogue, but also education, financial education, basic financial education is essential. In a paper, we try to demonstrate that where financial literacy, not just general education, is higher, pension reforms are politically less costly. And we demonstrated it. And so I'm very proud, and I think there is a cause to change the paradigm for pension reform. I am finished.
Thank you very much. So now I'm very happy to hand over to Mario, who will talk about issues related to his experience at the National Authority supervising the market for pension funds.
Okay, thanks a lot. Let me start with a few things. First, I want to thank Professors Nicodano, Calvé, and Gomez for the invitation. I really appreciated that. I mean, for me, it's a way to be back home. I work on these topics And I know the group from its very start. It's an excellent group made of excellent researchers, and I warmly invite all of you to come, tomorrow and the day after tomorrow to the conference, because there are a number of very nice papers that will be presented. Then I want to thank Professor Giorgio Barbanavaretti for the introduction, Professor Paiella for the nice word there, for doing an excellent job in setting the stage for our panel, for the conversation that hopefully we're going to have afterwards with your contribution as well. And of course, it's a pleasure and an honor for me to share the panel with Professor Fornero and Professor Zeldes, which I want to thank them for accepting to be here, despite I was here as well. And of course, I thank all of you for having the patience and being here and with us and possibly chatting with us afterwards on pensions. And now, acknowledgements are fine. Now it's apologies. Let me apologize for the title. It's not very exciting. And the subtitle is possibly even worse. I mean, it's hinting at, an ancient Greece myth, but it's just for lack of better ideas. But anyway, I'll try to, talk about a little bit about how the private pension system in Italy works, also trying to draw comparisons with other countries, just to make you to appreciate what is special in the Italian system, what is different from what happens in other countries, and also what is actually similar, because in many dimensions we as Italians are not that special as we think. Actually, we are similar to many others in many respects. I think I need to. Okay, that's the machine to.
Sorry.
Okay, very good. Okay, to do so, to provide you with some knowledge of the private pension system, let me give you first some institutional background. Okay, first of all, enrollments and contributions to the private pension system in Italy are not mandatory, are completely voluntary. I mean, people might decide to be or not to be enrolled to a private pension funds, and I will clarify in a second what do we mean by private pension funds. They might decide whether or not they want to contribute. As a matter of fact, one issue that we have in Italy is that actually many people who are actually enrolled do not contribute, which for the reason I'm going to give you in a second is a pathology of the system. It's not a very good thing. And private pension system are existing in Italy actually since a lot of time. Actually, they are very old in some for some group of workers, especially for workers in the banking and insurance sectors. I mean, for obvious reasons. While for the generality of workers, the pension funds started to become available in the late 90s. I mean, the major reforms for pension funds is dates 1993. That phase it's not by chance. I mean, that phase was the phase in which, the transition from the pure pay-as-you-go DB system towards a more DC system started also for public pensions. And the pension funds which were already existing in the 90s are called the pre-existing pension funds. I want to give you the name not because the name is important in itself, but because it's gonna help me to give you some numbers afterwards. The system, as I was mentioning, started taking off at the end of the 90s. The most important, the largest Italian pension fund was funded in 1997. Is the Fondo Cometa, that's what it's called. It's the pension funds for metal workers and mechanical engineers. Pension funds in Italy are, as I will mention in a second, but anyway, let me say this now is, many pension funds are based on the national labor contracts and are sector for industrial sector pension funds. This is different from what happens in other countries where, employer pension funds are actually sort of firm pension funds. But in Italy, I mean, the idea was to have this sort of very large sector pension funds. Beyond pension funds, the other pension fund, beyond pre-existing pension funds and the closed pension funds, which are, the funds I was mentioning, anchored to the national contracts, which are comparable to the 401k in the US, if some of you is familiar with it. I mean, there are, the so-called open pension funds, which are offered by banks, insurance, and asset management companies, which are both collective and individual in terms of enrollment. And then the third category is this PIP, individual pension plans. These are more insurance products which are offered by insurance company, and the enrollment is on an individual basis. Okay, let me give some numbers about the system, just to sort of to give you an idea of how the system is, if it is large or not. In total, in Italy, there are 332 pension funds, okay, operating. This number has been decreased. The number of pension funds operating in Italy has been decreasing over time, okay, because the system is actually consolidating, which is a good news, actually, because consolidating means basically making, saving in costs, basically. The number of accounts is about 10 millions. Accounts are different. It's a different number from members, because there are, people who are actually workers who are actually enrolled in more than one pension fund, which is not necessarily actually a good idea, because you pay some fees basically twice without, getting much in terms of diversification. And then the asset under management are around 200 billions. I mean, the first question you may ask, and I asked myself when I started, working on the private pension system, is, whether or not the system is large. Is it large or is it small? What do you think? Is it large or is it small? Okay, how do we judge whether it's large? One way to judge it is basically to look at, to compare the Italian pension system with the private pension system with private pension systems of other countries around the world. Okay, and which is something I will do in a second. Before, let me provide you with some other numbers, which are also telling me something about the dimension of the Italian private pension system. Numbers which have to do with participation, both at the extensive and at the intensive margin. The participation rate, tells us how many workers are actually covered. Pension funds, one way or another, in general, pension systems, as Professor Fornero was telling us, are designed, are conceived to insure against longevity risk. The risk of surviving, the resources that you accumulated during your working life. That's what pension systems actually do. Then the question is, what is the fraction of population which is active population, workers population, which is covered by pension funds? In Italy, this fraction is 36.2%, which is again, I leave it for later on to say whether this is a large or a small number. Contributions are on average just below 3,000 euro per year, And this number takes into account the fact that there are many, as I was mentioning before, actually there is a large fraction of members who do not contribute at all on a yearly basis, and even for more years, even for several years. However, these numbers, and this is very typical with the Italian numbers, hide large differences. For instance, this is one difference I want to point out to you, but there are other differences which are equally relevant. Here I'll plot, basically two graphs for to show you the differences in terms of the intensive and the extensive margin of participation to pension funds across geographical areas. And this is the usual divides that we see for Italy. In the northern Italy, participation rate are higher and average contribution are higher compared to southern Italy. You have similar divide between males and females according to age. I mean, in many ways, the Italian private pension systems reflects the many divides that we see in the Italian society. Then these numbers are not really surprising, but just to tell you that, as usual, the average numbers then hide, profound differences between people. And then let me get to the answer to the question: is the system big? Okay, this graph is plotting asset under management over GDP, which is a measure of, arguably, is a measure of the size of pension system for a number of countries. First, new apology, the labels are in Italian, but are are quite easy to understand. Italy is basically not very, asset under management divided by GDP is not a very large number. It's below 10%. Then it's not a very large number by international comparison, which drives many people to think, okay, the system is actually small compared to the other countries. But then let me give you this other graph, and this is plotting on the vertical axis the contribution rate to the social security, to the first pillar to be precise, and to the against on the horizontal axis asset under management divided by GDP. And you see that there is a gradient, which is a negative gradient, which is, perhaps not very surprising. I mean, in countries where the social security or the first pillar contribution rate is higher, and Italy is the example in that front, because Italy has one of the highest social security contribution rate, the size of the other pillars is small. Okay, then the Italian private pension system is small, but it's not that small, because we have to factor in the fact that the contribution to the first pillar is very high. The first pillar is big in Italy. Okay, now let me move on to something on tax and financial regulation. I'll try to be as quick as possible and not giving you too many details, but just the most important things, because I think these are, that's useful for us to, to have a discussion later on, maybe. Tax regulation. Tax regulation in Italy is entirely set by the national law, okay? This is because, Italy is part of the European community, but, the tax law is outside, it's not the kind of matter the European, the EU cannot be legislated at the EU level. It's legislated mostly at the national level. While financial regulation is both national and European level. Why this is important to take into account? Because, when it comes to, we are very far from that, actually. But when it comes to, conceiving a European, pension system, we are very far from that. But when it comes to that, we need, the standard, the rules to be the same across European countries. Of course, we are very far from that. We are not like the US. There is, in the US, there is one social security number for all states. Then you have state pension funds as well, but the social security is one for us. In Europe, that's not the case. But there are, something has been done in the last few years in trying, at least on the private pension second and third pillar dimension, trying to do some pan-European product. It's not easy. It's not easy because, for instance, since the tax regulation is national-based, we have different, across European countries, there are different tax regimes, different tax models. And I think Steve is going to talk about, the tax models, the tax regimes for pension funds later on. In Italy, we have, the so-called ETT model. Italy is a bit strange in that respect because in most of European countries actually adopt the EET model. And actually most countries in general adopt the EET model. The ETT model means that contributions to pension funds are tax deductible up to a maximum which is about 5,000 euro. Returns are taxed 20%, and benefits are taxed. It's not the standard tax rate. It's a separate taxation, and the tax rate varies between 15% to 9%, depending on number of years of enrollment. Okay, financial regulation. Just in a single word. It's complicated animal, but in a single word is based, in a single sentence, is based on the prudent main approach. Even though there are, in the national financial regulation, there are some portfolio constraints. Okay, there are, for instance, I would say, for instance, there are portfolio constraints on illiquid assets. Are not really binding. The portfolio constraints for illiquid assets states that pension funds cannot invest more than 30% of their asset in illiquid asset. 30% it's a lot actually. Any sensible pension fund should not go that far anyway. But anyway, there are these constraints. How the system works. Okay, a few words about how the system works before going to the issue I want to talk about. Okay, pension funds in Italy are defined contribution schemes. Okay, there are very few exceptions among the pre-existing funds, but the system is a defined contribution system. Is based on individual capitalization. This belongs basically to the transition from the more DB kind of systems to more DC kind of system. In Italy, from its very start, the system was designed to be a DC system, but this is not the prevalent DC, individual capitalization, fully funded. This is not the prevalent model in Europe, for instance. There are countries, for instance, in the Netherlands, for years, the prevalent model has been DB. Now, also in the Netherlands, there is a transition. The transition is actually, it's a long-lasting transition, which is not ended yet, towards a more DC kind of based model. The contributions are invested in financial markets, in international financial markets, which is good, because that's a way for members to diversify their portfolio. Because the first pillar is, as Professor Fornero was telling us, the first pillar is completely anchored to the Italian economy. Then, if the Italian economy goes well, the pension benefits, the expected pension benefits increase. If the Italian economy does not grow, then the expected pension benefit relatively decrease. Then, having a second and the third pillar, investing in international capital markets is a way for pension funds members to diversify their pension portfolio. The investment is, again, this is a bit different from what happens in other countries. The investment is actually in contractual closed pension funds. Is not direct, it's indirect investment. They invest through mandates. They don't do it on their own. While, of course, the open pension funds, which are offered by banks, insurance, or asset management companies, of course, they directly invest in financial markets. Pension benefits are paid as a lump sum up to 50% of the capitalized sum of contribution or as an annuity. Okay, I will not talk about the annuity market today, but I think this is, the annuity market is really an issue in Italy because it's virtually not existent. It's a, for a number of reasons that we know very well. I mean, it's a difficult market everywhere. There are a number of failures, but this is a little bit of a big problem, but I prefer to focus on something else today. They might, pension funds, okay, let me skip this, provide additional. And what I want to focus on now is basically the investment choices, okay? Again, in that respect, Italy is different to other countries, but similar to, there are differences and similarities with other countries. In Italy, the way it works is that pension funds offer at most 4 investment choices to pension fund members, okay? Which means, and these 4 choices are ranked according to their exposure to equity. There is one portfolio, one line, which is basically no equity, which is very similar to what is called the guaranteed contract investment in the US. And then there is a second line which is more bond-oriented with less than 30% equities. And then there is a third line which is called balanced, between 30 and 50%, and then the equity-oriented, which is at least 50%. Okay, these are called also sub-funds. Okay, and here is what, this is for the last year, 2000, last year is 2022, but more or less the same picture is for every year. Most
Clarifying question.
Yeah.
Is this new investment or is it the stock?
Stock.
The stock.
Yeah.
Okay.
The stock is basically out of the asset is divided between, actually this is the, is the stock. And, most people actually are in the guaranteed, the no equity line. Okay, I leave it up to you to judge whether this is good or not. My judgment is that this is not entirely good for several reasons. Okay, let me show you first this graph. This graph is giving us the annualized returns, from computed from using data from 2013 and 2022. And you see that this guaranteed contract is earning very little compared to the other lines, which is not surprising. One thing that 3 minutes, okay, I'll manage. One thing that I should say is that, and again, this is different from what happens, for instance, in the US. In the US, people tend to, or might tend to spread, the contribution across the different lines. This is also possible in Italy. I mean, you can spread the contribution across the different lines. You can switch without incurring any additional cost from one line to the other. Then there is plenty of flexibility. However, Italians don't do. I mean, what happens is that people end up staying in the enrollment line. And the guaranteed contract is actually the default enrollment line, because we also have the default option in Italy, which is important to understand why many people are actually in the default or in the guaranteed contract, but it's not the only reason. It's not the only reason. I mean, it's not that we see all these people in the guaranteed investment contract. It's not just because this is the default option, because actually auto-enrollment, self-enrollment in Italy is not very pervasive. People make an explicit enrollment. They say they want to enroll. I mean, by the way, actually the system is designed. Of course, there is an implicit message. I mean, if the message is, the guaranteed contract is the default option, that must mean to many people that this is the right investment line. I mean, it's a framing problem, but I think it's what explains what we see in the data. And also, I mean, this is part of some new work I'm doing. You see some positive age gradient. You know, the percentage of people investing in the guaranteed investment contract is actually increasing with age, which might sound sensible, except that it's very difficult to, you know, attach any structural interpretation to these age gradients, because, as you know, it's basically without further assumption, it's impossible to disentangle from this data. These are the administrative data. It's impossible to disentangle. These are repeated cross-section. There is also a panel dimension, but this is, you know, it's impossible to disentangle age, cohort, and time effect. Then, you know, sort of estimating a positive age gradient, this positive age gradient could actually be driven entirely by, for instance, cohort effects. Then, without imposing, you know, restrictions, you don't really know where this gradient is coming from, and this is something we are doing now. But let me just, I have to conclude, I guess, very quick. Asset under management, you know, how Italy fares compared to the other countries. Again, apologies, the labels are in Italian, but the main message of this graph is telling you that precisely because, you know, most people are in the guaranteed contract, which is the no equity lines, the exposure to equity, how much pension funds invest in equity in Italy, is limited compared to many other countries, which is a bit paradoxical because pension funds should be long-term investors, and then equity, in a way, is the right asset for them. Okay, and then I'm out of the time. Just let me conclude with this final sentence, and then I think we're going to have plenty of time to discuss. There is room, I think, to improve household portfolio choice. You know, and there are two ways to do it. One is, and I think these two ways are not alternative. One is actually through financial education. We should make an effort to sort of try to people teach what is what are, you know, sound and good and wise financial sources, but then the other avenue is actually financial architecture. I mean, we should design options in such a way to make people to make the right choices. Okay, thanks a lot.
Thank you, Manuel. And I'm very happy to hand over to Steve, who will be talking about the transition from DB to DC systems and about taxation with an eye towards policy proposals. Thank you, Steve.
Great. Thank you very much. It's very nice to be back here. The last time I was here was about 5 years ago in this same room. I really enjoy being here with this group, and also like the area and the region, and have some family ties here. So thank you for inviting me back. So some of the things that I'm going to talk about have been touched on already, so I'll be able to go a little faster on those parts. Before I start, I just wanted to get a sense of the room here. How many students here, how many people here are students? And how about faculty or otherwise associated with the university? Okay, and how about neither of those categories? Okay, so we got one. Okay, a couple. And we have people online I can't see, so I can't ask you that question. But anyway, it's nice to be here. And of the people who are students, anybody interested in studying pensions? One. Okay, good. Let's talk. Hopefully we can persuade some of the rest of you that it's an important topic. So I'm going to talk about three different things. One is the transformation from defined benefit to defined contribution. We've already talked a little bit about that, but I'm going to show you some things in the U.S. Second is about reforming defined contribution plans, and third is reforming Social Security, the first pillar. So talk about both the second pillar and the first pillar. So begin with, and I'm going to touch on a bunch of different topics, many of which I've done work on and am doing work on. And so hopefully this will, I thought I'd touch a bunch of different areas that give us whatever people want to talk about afterwards in terms of everything that we've all talked about. I look forward to some quick conversations afterwards. So this just shows you the transformation in private pensions in the US. And this is the percent of workers covered by traditional defined benefit pension plan, defined contribution plan, and both. And what you can see is this like big X-shaped pattern. So there's been a huge transformation. You go back to the beginning of the graph. Basically, this is of all workers in the private sector who are covered by a pension plan. So this is conditional on being covered by a plan. We saw the vast majority were covered by defined benefit plans when this graph starts, and now almost none of current workers are covered only by a defined benefit plan. Whereas defined contribution plans were small in terms of coverage, and now it's the vast majority of workers are in a defined contribution plan, with some fraction that have been in both the whole time. But a massive shift in the United States. And this graph is taken from a paper that Josh Rowan and Irina Stefanescu and I did in the Journal of Public Economics. And we asked the question of, why did this happen? Let me just show you one other graph before I give you some of the answers. This is just looking at the total retirement assets in the United States. Back in 1980, about 23% of it was in defined contribution and IRAs, and now about 63% of the assets are in defined contribution and IRAs. And the reason IRAs are individual retirement accounts, and basically the reason those are so big are because when people leave their defined contribution, their occupational plan, their defined contribution plan, they roll over assets into individual retirement accounts. So almost all that money that's in IRAs is money that's been rolled over from DC plans. So we see 63% of the assets are now in DC and IRA plans. Again, a big shift. So what caused the transformation? What we argued in this paper I just mentioned was that it actually saved firms a bunch of money. Why did it save firms money? Because when they froze existing plans, they basically did not give older workers as much in terms of defined contribution benefits as they had accrued or were going to accrue in defined benefit plans. So the accruals in defined benefit plans steep highly toward seasoned workers and older workers, and those workers, instead of getting those high accruals that they would have gotten under DB, instead got much lower accruals under DC, so it actually saved firms money. That's one argument. There seems to be a general lack of interest in annuitization, and there's a whole literature on that, like why don't people like to get lifetime income? But when given the choice, they seem not to, and the idea of having, so that I think is part of the explanation. I think there's concern over counterparty risk, that workers were worried that the pension the defined benefit pension wasn't going to be there for them. And I think there's just something about the tangibility of DC assets. You look at your account, you log in, you see you have $100,000 in there, and it's very tangible having that. So I think that was a draw as well. But I think there are other reasons that still we don't fully understand as to why this transformation is happening. And it's not just, by the way, it's not just, I showed it to you in the US, but as we heard earlier, it's happened in Italy, it's happening in many other countries around the world, this big shift. Okay, so, sorry, this doesn't, this way it goes backwards. Okay, so the ongoing challenges for the system, for the DC system, one is about coverage and take-up. A second is about the fairness and progressivity of the system. A third is about the kind of choices that people make or don't make in the plans. And a fourth relates to fees. And I'll just touch on some of these briefly. So first of all, access. This is data from the US. Only about half the workforce has access and participates in a retirement plan at work. Okay? There's another 17% that have access but don't participate. So that brings us to 70% of the population. And then there are about 30% of workers who, these are in private industry workers, who don't have access to a plan. So the plan is just not offered at their institution. So access is one issue. Participation is a second issue. Next point I want to make has to do with fairness and progressivity. The tax benefits, when you look at defined contribution plans, the tax benefits, as well as the firm contributions, are tilted quite heavily toward high lifetime income households and also towards sophisticated households, because there are a lot of things you have to do in order to get the full amount. And so sometimes that's complicated, and therefore more sophisticated households tend to take advantage more of the system and the various tax benefits that are allowed. So the tax benefits are tilted both toward high lifetime income and sophisticated households, many of whom are the same. And if you look at, dig deep into the system and who benefits from the various incentives, there's a nice new paper by the authors that are listed up there. There are too many to mention, but there's a very nice new paper that just came out that sort of details how it's tilted toward high income households, and they connect not just pension data, but also tax data to be able to look at households. So I'd encourage you to take a look. I think there's a lot of scope for improvement, and I'm going to give one suggestion a little bit later. This is we already talked a little bit about, you heard earlier about some of the way that the different tax treatment, and there's, TEE, which is, you tax the money up front and then it's exempt from there on after. There's EET, which is you get a tax break early on and then it comes later, and there's TTE, and there are various other things. Anyway, here's a picture from the OECD of what various countries do, and different countries do different things. The US is primarily EET. It's called traditional in the US. It's backloaded taxation, and we do have some component of TEE, which is called Roth in the US after the name of the senator who first proposed it, and that's front-loaded taxation. So we're primarily EET. In Italy, as we just saw, we're ETT. So a variety of different ways of doing things around the world. Does it matter? So I'm going to compare now, and this is based on a paper with Mattia Landoni that's listed here. There's the question of, does it matter whether we have TEE or EET? And there's a simple benchmark model that's not new to us that basically says no, that if under certain assumptions, it doesn't matter whether you tax up front or tax at the end, it turns out the same. Okay? We argue in this paper that even though the simple benchmark says no, when you do one small change to that simple benchmark model, which is to take into account that asset managers charge fees on their financial products, when you just take into account that one additional feature, it basically these two systems are no longer equivalent. And the intuition is, if you have money in an EET plan, part of that money that you have in there kind of belongs to the government, right? Because you're going to pay taxes on that. If you're going to be in a 20% tax bracket when you retire, 20% of your money in your account is actually owned by the government, right? Whereas the other 80% is yours. So the government, just like you are paying asset management fees on your amount, the government is paying asset management fees on its amount. And so it turns out that it turns out to be a fair amount of money that asset managers end up charging fees to the government on the implicit account, and it's kind of a deadweight loss, it turns out, or largely, not completely, but largely deadweight loss. So I don't think I'm going to have time to go through the examples, but I'll in detail, but I'll just flash them up here for you. And there's kind of a benchmark result under, here's Roth, here's traditional, and it turns out that under the benchmark, you end up with the same money either way, whether you get taxed at the beginning or taxed at the end. And it's just like if you had a Roth account, having a traditional or having a TEE account is like having an EET account plus an extra little piece that's just owned by the government, as I just mentioned. But when you have investment fees, and again, I won't work through the numbers, but it turns out that individuals pay the same fees, but the government ends up paying fees to the asset managers. So what this is, by having a TEE account, it basically is a subsidy by the government to asset managers, and it's a pretty substantial subsidy. And we do some calculations. So the total assets under management are significantly larger under a TEE, because part of that money is just money you put in, and the government's going to take away at the end, and it's not really your money. Okay, so the assets under management are quite a bit larger. In the U.S., it's about the implicit account of the government is about $3 trillion, or $3.8 trillion, and about $2.5 trillion of that is in stocks. The average fees that are charged on these accounts, on all retail accounts in retirement accounts, is about 77 basis points. It's much higher in Italy, by the way, but even this in the United States is pretty high. And so it turns out when you do all the calculations, you get that the annual subsidy to the asset management industry from they have much more assets under management. The implicit extra fees is about $23 billion of money in the US. Okay, so there's a substantial amount of sort of extra fees that are paid. It's basically a subsidy from the government to the asset management industry as a result of this. And we argue that we'd be better off if we had it in EET rather than TEE, as long as it's done right. So here's the subsidies for other countries too. As you see, the fees in Italy. Sorry, I don't have Italy in this graph, but the fees in Italy are substantially higher. You look at the fees in some of the other European countries, it's 100, 150 basis points. Canada, it's about 200 basis points. So those fees add up when you add them up. So you might think, well, there's a lot more fees, there are a lot more assets under TEE, and so maybe that. Maybe they'll charge maybe they'll charge lower fees. This is supposed to be TEE up there. Maybe they'll charge lower fees under TEE, right? Because there are a lot more assets. So they have a lot more assets to management, their economies to scale. Maybe they would just lower their percentage fees. Will they? No. We argue in a model, we prove what's called a supply-side fee equivalence result, that there's no incentive, even though they have a lot more money that they're managing and they're increasing returns to scale, there's no incentive to lower fees. In fact, we've proven a model that they'll basically keep the fees the same, the percent fees the same, even though they're gaining these economies to scale, and it all comes up in the markup of over costs. So firms charge higher markups and get higher profits. What happens in general equilibrium? I have this little picture of a milk and cow up there, because you could imagine the same kind of question. What happens if the government subsidizes milk by buying one quart of milk for every 5 quarts that the public buys? The government just buys a quart of milk. It's sort of a similar kind of story here. And so the question is, what happens in equilibrium? Well, we argue that basically, as I just said, the assets under management of asset managers is higher, the profits are higher, and or the whole size of the asset management industry grows. So the asset management are either they make more profits or they grow and scale, more firms enter, and that involves higher costs per firm. But in any way, there's an expansion of both profits and or the size of the industry. And we argue that social welfare is lower, so that people are worse off as a result. And if you instead flip to TEE, the government could afford to create a 6% government match with all the money that it saved on the fees that it was paying. So it could just give out 6 cents on every dollar that was contributed on average in the retirement system. And that's just my graphic of the asset management industry getting big. Okay, so our proposal here is TEE with a progressive government match. Yes, TEE with a progressive government match. So you tax it all up front, and then it's exempt from there on. We argue that the government should have a large government match directly, and that the match should decline with current income and should decline with cumulative lifetime contributions in order to be based basically on lifetime resources. So we think this can reduce the dependence of the subsidy that's out there on the tax rate and enhance progressivity. There's a recent plan that was put into place in 2022 in the US called the Savers Match. And this kind of expands on that idea. It's a larger and more progressive savers match. And I put this article because up on the bottom right there was Peter Thiel, who's a tech mogul in the U.S., has a retirement account, a Roth retirement account that's $5 billion in it, just himself, right? And he got this because he took some non-publicly traded stock early on in one of these companies that grew very fast, and it just grew immensely. So we argue that you should restrict. First of all, and when you're going to do this, we have to restrict it to hold only publicly traded assets. You can't put privately traded. We don't think you should be able to put privately traded assets in there. And second, we think you should limit the total size of the tax advantage that you get, so that someone doesn't have a $5 billion retirement account. Individual retirement account. So that's our proposal, and there's our little graphic of the match with the piggy bank up there to remind you about it. There's been some move toward what's called Rothification in the US, but it's still in the early stages, I think. Next thing I want to just mention in 1 minute is what happens with asset allocation. We already heard a little bit of that discussion. In the US, there's a lot more investment in equity. About 2/3 of all retirement assets are held in all DC assets are held in stocks. So there's a lot more equity holdings in the US. Part of that, but not by any means all of it, is due to a rise in target date funds that basically automatically adjust the equity share as people age. And I've done some work on this in the past, but starting some new work on this, looking at a large asset manager in the US and looking at what's happening with how the introduction of target date funds and the growth of target date funds is actually influencing allocations of asset allocations in the US. And finally, in just 2 more minutes, I want to talk about reforming the public plan, since we're running a little short on time. In the US, as we already heard, it's largely a pay-go system, a pay-as-you-go system. This is the costs and non-interest income past and projected, and you can see that things have been we're running kind of surpluses for a while, and then some small deficits, but then that's just supposed to break out. We're projected to run huge deficits moving forward, and that's the challenge: is how do we deal with this? This is the trust fund. We actually build up a little trust fund in the United States. It's up at around $3.5 trillion, but it's headed rapidly towards zero. So by 2034, there's not going to be enough money in the public fund to pay benefits. So that's going to come between now and then. There's going to be a lot of political discussions in the U.S. and what to do about that. Currently, there's a fiscal rule that's fixed by law. The contributions are fixed, the rules are fixed, the benefits rules are fixed, and then there's a budget constraint that says the trust fund kind of takes money in and sends money out, but the trust fund can't go negative. It has to stay always non-negative. And that was the graph I just showed you. It's scheduled to go negative, so something's got to give. And what we are looking at currently in some ongoing work with John Giannakopoulos is to look at the system, the historical system, on a generational, cohort basis. And basically, the early generations, as Elsa was pointing out, got kind of a good deal out of this. And they got positive NPVs out of the system when you look on a cohort basis. And subsequent generations were getting negative NPVs. But when you look at, this is the data that we've been collecting and working with, and it's the net present value by cohorts. This is by birth year. And you see that the early generations that's that blue area on the right, got very positive NPVs out of the system. Then there was a set of cohorts that got negative, but then it's scheduled to go positive again. And that's not sustainable because the sum of all these things, basically, the red, the blue, and the green has to be zero. And it looked like it was going looked like it was going that way with the red, but it's not going that way anymore. So something has to give. And so our proposal, and this will be my last slide, is we argue that you know, there are these promises to past workers. We gave this money, a bunch of money to past workers, and why should the current workers have to pay for that, right? Not just, I mean, obviously some of on a pay-go basis, money flows in that direction, as we already heard. But why should just the current workers get kind of a bad deal, current and future workers, a bad deal to pay for the past workers? It's a debt borne by society, and we argue that we should be have a dedicated tax on general revenues, not just current workers, but all income, including capital gains and other forms of income, that should be going to pay the legacy tax. And it shouldn't be borne on the backs of just workers. And also, there's an earnings cap, so workers above the earnings cap in the US don't pay anything. So we argue it's sort of unfairly targeting current workers not at the top of the income distribution. So we argue that it should be a broader tax, like a dedicated tax on general revenue. That'll cover about half the Infinite Horizon shortfall, and then we need to do something else in terms of either cutting benefits, raising taxes, or some form of cutting back benefits or raising taxes in order to fund the rest of it. And we also argue for self-correcting mechanisms so that once we adjust the rule, we don't have to keep adjusting it in the future. And of course, this poses political challenges, right? How do you modify? We have a very strong fiscal rule in the United States, right? By law, we cannot pay benefits more once the trust fund runs out. We can only pay benefits equal to the contributions. In Italy, it's not quite that way. It's a little looser, right? So how do we modify the fiscal rule that's very strong, but then protect it again from changes in the future, right? Because if you give up too much of the fiscal rule, you run the risk of spending getting out of hand. So that's the political challenge. I don't have an answer for that yet, but just want to raise that. So let me stop here and open for discussion.
Thank you. Thank you, Stephen. And so I think that we can open up to questions from the floor. And while I wait to see how I can get the questions from the virtual audience.
We're going to have to start asking you guys questions.
Can I just ask a very quick question? Your proposals on taxation.
Yes.
Is there a party in Congress supporting it? Is there discussion in Parliament?
We haven't gotten that far. There is. You're talking about the DC side.
Yeah.
The second pillar.
Yeah.
There is some support for moving toward toward TEE, but it's not really for the reasons we think it's important. It's for the reasons that it generates more money up front for the politicians, right? So, because EET, they get the money later, TEE, they get the money up front. So politicians tend to like it, but not necessarily for the reasons that we like it. What we are arguing for is that, so I think there is potentially political support for it, but what we're arguing is we want to enhance the progressivity of the system along the way at the same time that we're doing this. So I can't tell you yet politically how that's going to play out, but possibly.
But
Okay.
the asset managers realize the difference, right?
The asset managers what?
They know the difference in terms of how much they earn between the two models.
I can't say for sure what they know, but I believe they are aware.
Because
of
if
this,
they
yes.
don't know,
because
it's better,
it
right?
basically would scale back assets under
Yeah.
management for the asset managers. Yes, so they might.
Right, because if they realize, fully
They
realize,
might not like it.
they might not support
Maybe
very
they-
much.
Maybe they did lobby for the law. Who knows?
Yes, there is a question from. Please.
Thank you for a very interesting presentation. Thank you. Yeah, so thank you very much for a very interesting discussion, very rich. We got to learn a lot. I mean, just to kick off the discussion, I mean, overall, what would be your, recommendation? What would be your preference? How should we move forward, given the current situation, I would say, in Europe or in the United States? What would be the best policy reforms you would recommend?
I've already given you two, so I'll let the other panelists.
Well, my short sentence is that the better foundation for good pensions is a well-functioning labor market. So, okay, try to set the architecture of pensions. I think transparency is fundamental. You have DC, you know that DC is insurance. Then you have solidarity, and that's a way to take away privileges, and that's also a natural feature of a public pension system. But then it's not just a matter of political promises. It's a matter of how the labor market function. So productivity, which requires a lot. But the idea that it's changing the pension systems that delivers good pension is not enough. You have to change to make the system sustainable. But then you have to work on the economy, and even more difficult, on demographic change. Migration, and what we said before, for example, France has a very different demographic scenario from us. They are not a diminishing population. We have a rapidly diminishing population. So it's the economy and it's the demography that matters.
Yeah, we've seen a very large drop, obviously, in the number of children that each
Absolutely.
couple has, right? Or each adult has.
1.3, 25 per woman fertility is, and we were one of the highest fertility rate in Europe. I mean, my own generation, so it's not too ancient.
Yes. So you could all have more kids, and that would solve part of it.
Now there are a couple of more questions. Can I please ask you to state your name and affiliation?
Hi, my name is Olga, and I'm from Leibniz Institute for Financial Research, SAFE, in Frankfurt. I have two questions, actually. First of all, you mentioned financial literacy, but there is, so in my mind, I'm from Russia originally, and I've been in Europe for a long time, and every country that I come in has their specific rules and institutional setup for pension saving. So I sort of have to relearn every time. And if you measure me on the financial literacy scale with a PhD in finance, I would probably score quite high. But still, my knowledge, or complexity of the system prevents me from potentially, or takes me longer to actually contribute optimally to my pensions. This is my first question. So how do you measure financial literacy in the research that you do? And whether you think there will be a difference if you actually measure literacy about pension system versus literacy overall. And the second question is related to this move to green or ESG-oriented pension savings. Because a lot of pension funds, at least I know some, are moving towards providing a plan not various in risk, but also, for example, with ESG focus. Absolutely. And I mean, there is some evidence showing that people are more likely to switch to that and start contributing using the ESG as a catchphrase, or they want to contribute to saving the planet, and that's the way for them to do that. How do you think this would affect pension system, if it can be implemented, if it needs to be implemented, or what's your opinion on that? Thank you.
Thank you. So maybe we can take also the other questions, and that you can reply. Yes, there is also another.
Hi, I'm Sasha Ndarte, and apologies for my voice being a bit hoarse today. lost it recently. I'm from the Wharton School at the University of Pennsylvania, and my question is about, there's a lot of political uncertainty about the will, and it's starting to become questionable, the feasibility of doing reforms for pensions, retirement ages, Social Security in the US. And I'm wondering what your thoughts are, I'd like to ask this of everyone on the panel, about how this uncertainty might affect consumers' behavior. Are they potentially going to engage in excess saving? Could that create additional drags on the economy because they're saving rather than spending? And what do you think the potential costs of this uncertainty are?
Thank you, and we can take the third question, and then maybe we can...
Hi, I'm Martin Brown from the Study Centre Gerritsen Say in St. Gallen. So I have a question to Stephen. You showed us some data that there are quite a few people in the US who have access to a plan but don't enroll. Now, supposing that you'd introduce a system where there's upfront taxation, do you think that the share of people who don't save then would go up because it's no longer tax deductible? So what do we know about empirically about the elasticity of sort of pension savings to tax deductions or upfront tax deductions?
Okay, thank you. Maybe we can now go in reverse order, and Steve, you can start.
Sure. So let me go backwards. So in terms of the last question, I think it's an interesting question whether the TEE versus EET is going to induce more participation. As you show in the benchmark model, they're equivalent economically, but nevertheless, they may be perceived differently, right? And the question is, if you have rational people who fully foresee that they're going to pay the taxes in the future, in the benchmark at least, there's an indifference result. But then what if you say, well, what happens if people don't really think about the future taxes that they're going to have to pay? They don't realize they're going to have to pay future taxes on the EET plan. It could really go either way. They're kind of income and substitution effects, right? On the one hand, they feel richer, so maybe they save less. On the other hand, they feel like they're getting a great boost, so maybe they save more. You really have to delve into the area of behavioral economics to really understand. It's not clear to me that there'd be such a major difference in terms of incentives on those two things. Do you want me to answer? Address the other ones too. So Sasha, in terms of Sasha's question about uncertainty and the impact on reform, I think it's a huge problem in the U.S. that we have 10 years till the system's going to run out of money, and there's just constant. I mean, there are a lot of articles in the press about this, and it's going to get even worse as we approach that. And I think young people kind of lose faith in the system. So I think it's a big mistake. I can't tell you exactly how that influences saving, but I can tell you, I think that it's a mistake to. It just hurts the reputation of the system because young people keep thinking, oh, it's not going to be there for me. It's not going to be there for me. So I think there are huge political costs in waiting this long to reform it. In terms of how it actually affects behavior, I'm not quite sure. And then on the first question on the design, should we improve financial literacy, or should we improve pension design? We can always say that it would be good for people to become more financially literate, and I teach some of this stuff to students, and I believe in it. But I think it's very important to improve the design, right? Our systems are very complicated, and you shouldn't have to have a PhD in finance to understand that what to do here, and here in order to optimize the system, right? We should have simpler rules and better design so that doesn't happen.
Okay, thank you. Yes,
I agree. I mean, this is very important. I mean, we need to have a right mixture between. I mean, of course, we need to educate people. Education is needed, but it's necessary. It's a necessary condition. But then you need good designs because, it's important that people are put in the position of doing, the right choice, and this should not require people to be extremely educated. I mean, we all go to school but then, some design is needed, and this is pretty much clear, I think, when it comes to the choice between, talking about portfolio choice within pension funds. This is pretty much clear when it comes to the choice between pension plans. Saying that the default option is the guarantee contract is telling a lot. It's not just, it's the framing there that is important, because it's saying, okay, if the default option is the guaranteed contract, you should do the guaranteed contract. And then what you see is that actually many people who are investing in the guaranteed contract are not actually those, the default option guys. I mean, are people who believe, and they stay there forever, for all their entire life, earning ridiculous amount of money. And this cannot be optimal. I mean, some diversification, some equity is needed. And of course, you have to teach people what equity, equity, what is an equity, you have to teach people return, you have to teach people the law of interest compounding, you have to teach people all these things, but you also have to help through the, some adequate financial, design, pension design. Of course, and then going back to what the other question, what Elsa was telling us before, good design and financial education are again not enough, because the sort of issues that we have in Italy with our pension system, talking now about the first pillar, the social security, have to do with the demographic transition, which is affecting many countries, not only Italy, and also the low growth. I mean, that's the challenges. Then it's not really a matter of just designing and doing right reforms, but it's also a matter of making this country to grow more and possibly to sort of, a country with sort of, with a because this is, I don't know if that was said or not, but Italy now is a country with negative population growth. It's not just lack of kids, it's negative population growth. I mean, of course, with negative population growth, no system is sustainable. I mean, it's negative. I mean, negative population growth is the perfect disaster. Unfortunately, there are reforms, but there are also counter-reforms, and that goes back to the question on uncertainty. I mean, there is a lot of political uncertainty surrounding pension policies or pensions in general. Yes, there is uncertainty, but also not. I mean, if I think about Italy, it's pretty much clear that in Italy, if you promise people to go to retire earlier than the age at which they should retire for the system to be sustainable, you win the elections, okay? And this is very predictable. I mean, there is no uncertainty. I mean, you win the election with probability 1. That's what, some parties regularly do. I mean, I'm not anymore the chairman of the Italian authority, then I'm free to say whatever I like. And it's then, and of course there are, and that's more or less the history of this country in the last decades. There were, important reforms, but also minor and counter reforms. And people seem not to realize that there are no free lunches. I mean, if I want to retire before, then the age which is compatible with equilibrium, and then someone else has to pay the bill. That's all. And then I'll conclude with ESG. I mean, ESG is, it's very, I mean, the regulation in Europe is not yet completed. That makes things very difficult, because what is ESG and what is not ESG is very hard to tell, which open the room to what is called greenwashing. That said, the question is, okay, at the end of the day, pension funds should invest their money to maximize, expected pension benefits. Then whether or not this can be accomplished by, investing in ESG, it's an open question. I mean, if this is a bubble or not, it's actually there are signs that this might be actually bubble, but it's an open question. From the financial industry viewpoint, it's a clear profit opportunity. You know, that's the reason why there is a lot of pressure. You know, and there are, despite the fact that the regulation is not yet completed, there are plenty of financial products, also pension products, selling ESG lines or stuff like this, because this is a market opportunity for the system, for the industry. Whether or not this is good for the individual households, you know, this is entirely to be shown. I mean, it's not clear to me that, you know, investing in this ESG, taking these ESG factors into account leads to better portfolios. And I think we answered more or less.
Thank you. Elsa?
Okay. I'm a strong supporter of financial education. I always had basic financial education because we are not going to make people financial expert. This is not the point. I see there is a lot of business now in financial education initiatives. Sometimes it's totally misleading. What we want is something like literacy. Literacy is important, like it was in early 20th century when parliaments decided that people should know how to read, how to make basic calculations, how to write, to sign maybe. So we are talking of basic financial education, economic financial education. And in the Journal of Financial Education that Anna Maria Lusardi is now chairing, and we wrote an article with one of my co-authors saying what is financial retirement education, basic retirement education. And I do a lot of applications with my dialogue with people, meetings, because it's the basic things. For example, the fact that it is an intergenerational contract, the fact that in pension funds you have financial risks. They don't understand. They say, but if I put my money there, I want a guarantee. But if it is a guarantee, then it's no longer private. It's like having a public system in disguise. So these concepts you may convey to people. And in the paper that we wrote with Anna Loprete, we took 22 reforms, 20 years, and it's an empirical exercise when in the regression you put exactly financial literacy, not general education, the electoral cost of reforms is lower, significantly lower. So it means that, in a way, it is exactly that it's the opposite of what Juncker said. We know, but they don't, the poor thing. Why shouldn't they know the basic thing? Politicians are not enacting reforms for the pleasure of being cruel to the people. It is something which is necessary. And if it is necessary, even if it's not perfect, because no reform is perfect, then you should convince people. And then it should not be like you said, that if you promise to lower retirement age, you win the election. Why should people be so stupid not to understand? They are not stupid. Who said that people are stupid? No, some may be. Even some politicians, by the way. I tell you an anecdote. Do I have time? Yeah. Okay. Before coming here, I had an interview with a newspaper. And they said, because there is a political party supporting the government, and the leader of this political party has made strong electoral success by saying that he wants to cancel the horrible pension reform that has my signature. And he has been saying... He has been saying this since the law was approved. In fact, it was the only party not approving, because at that time, given the emergency situation, all the parties were together supporting the technocratic government in doing the reform. So the reform was approved with a very large majority. The Treasury Minister is also from the same party. He wrote a document, well, the ministry wrote a document these days in which they praise the pension reform. So this journalist said, but are you aware that the Minister of Treasury has now become a Fornero supporter? I said, well, that's a paradox that they have to solve. It's not my problem, it's their problem. But the fact is very simple, that the Treasury Minister speaks to the international audience comprising the European Commission, the European Central Bank, the World Bank, all the international organizations, and the international financial markets. And so they have to be straight in what they say, while the other one talk to the electorate. And he can talk by slogans, but slogans are not what is in the title of your conference, thinking forward. So that is financial education. I believe it does not do the whole job. So you need good architecture in the decision and in the framework. I just want to say very few things on ESG. I have seen a change, and I am convinced now that many firms do not take ESG as just, it's something that we have to pay to the public because it's fashionable. No. They are now considering ESG issues seriously. Whether this is because the evaluators are looking very finely to these things or not, but it has become a more serious. So I am not really convinced that it is a bubble. No, I am convinced that it is a change, which is something that demand us, economists, not just to look at the maximizing rational agent. This is the past. Now we have a lot of behavioral research because people's decisions are much more complex and people are more complex, and it is their psychology that matters. It is their beliefs. So it's really more complex, but it's also more challenging. Going beyond the neoclassical economics, it's your job.
Thank you, Elsa. There is a question for Mario about the pan-European pension product.
Okay, I think we are really out of time. I mean, these PEP are basically individual product. And the idea is that the product could be originated in any European country and then distributed in all the others. And there are not many at the moment going, and actually none in Italy, as far as I know. The project is very ambitious, and the product is a bit complicated. That's why I think the market is not picking up. One issue with this, and then we conclude, this has to do with the tax regimes, precisely because the tax regimes differ across European countries, and this is not very compatible with a pan-European product. Then there is an issue with aligning basically the tax regimes between Europe, if one really wants these kind of things to grow and to become important.
Okay, thank you.
Anyway, any other question, they can send me an email and I'll try to answer.
Okay, thank you very much. It's time to stop here, and I would like to thank Giovanna, Francisco, and Loranna for inviting me and for helping organize the panel. And goodbye, and thank you to all those who have attended online. Thank you.